Declan, welcome to Validated.
Thank you for having me. Happy to be here.
Yeah, I've been meaning to have a conversation around this topic for a while. I think intents are one of those types of things that has caught on a bunch, but sort of snuck up on the market. And then maybe it's a little bit less hyped than it was a few months ago. But I want to talk about a whole bunch of different things today. Partially, what it's like building an intent-based protocol, how the sort of ecosystem that sort of Near has developed sort of fits into a bit of that thesis. 'Cause I think if people have heard about intents on a retail side, it's probably through something like Near's intent system, where people were able to buy, Zcash on Solana, like as Near as an intermediary, which feels very weird when you sort of say that sentence out loud. But there's a lot of interesting technical reasons under the hood why this is the case. But I want to start out, can you give us a little bit of an overview of what you guys have been building?
Yeah, absolutely. So Aurora Labs has actually been around since 2021. One of the kind of more active projects, I would say, within the Near ecosystem. And one of the things we realized early last year, because of course we'd launched virtual chains before we moved into intents, was that even when projects had their own kind of networks, their own L2s, there was still this huge barrier, when it came to bringing assets into that environment. And then, of course, Near Intents itself was born, and it's funny that you say, it sounds quite weird when you say it out loud, right, that you're using Near to swap Zcash. And, largely that was kind of a similar sentiment, very early on at the start. But what we quickly realized is being able to swap assets, from one network to another, based on one click rather than complicated bridging, actually needed to go one step further, because most users are swapping assets for a reason, and it's usually to deposit into a vault, to invest, whatever it might be. And that's really where Aurora Intents was born and came into its own. What we've done is create this suite of products that sit on top of Near Intents as a protocol to provide projects with seamless one-click user journeys for their clients, right? So whether that's simply swapping natively within the application without having to leave, whether it's being able to swap Bitcoin into Solana to automatically deposit into a vault, or being able to keep the same deposit address regardless of which network you're on. That's really been the core focus area for us, and that kind of product-led or product-first approach has resonated pretty well, with the projects and partners that we're working with.
So I want you to kind of have take a step back for us a bit. A lot of things you talked about are sort of outcome differences. It's a much simpler user experience. You have consistent deposit addresses. I think at first look, you could look at that and say, well, maybe the bridges just failed at UX, but fundamentally all of that seems like you could build a sufficiently sophisticated UI around something like that and abstract it away. Under the hood, what is actually fundamentally different about an intent as opposed to just a really good UI on top of a bridge?
Yeah, look, great question. I think I hear it quite a lot, right? There's something wrong with bridges. The UX is poor. But arguably, right, if they were that bad, people wouldn't still be using them, right? I don't think it's that they're broken.
I think people still use mortgages and the UX is pretty bad.
It's not much better in the UK either, trust me. But look at a bridge today. If I want to move assets between chains, I need to figure out which bridge I'm going to use. I need to switch the networks, approve the transactions. I need to ensure I've got gas across multiple networks. So it's not that it doesn't work. It does. It's just, it's very complicated. Where this intents model differs and differentiates is we're not asking users how to get somewhere. We're simply asking them where they want to go. And I think if you really break it down into its simplest form, that's the differentiator. We're not saying bridge my ETH to Base and then swap it to USDC. We're just saying, where do you want to go? And then automatically managing the execution behind the scenes. And of course, we're doing that on top of the Near Intents network.
Yeah. And so my understanding is an intent still does involve a bridging operation. At the end of the day, there is still, anytime you are moving an asset or a representation of an asset from one place to another. But one thing you hear, there is obviously a active bridging involved in that. But one thing you hear often is the setup of Near Intents is significantly hardened compared to like your typical bridge setup. So can you walk us through a little bit of how both the security model and sort of the operational model differences when you're doing an intent-based swap as opposed to like a bridge-based swap?
Yeah, absolutely. I mean, I think it's a common misconception to say that, near intents or Aurora Intents replaces bridging. It doesn't replace it, right? It's abstracting the complexity. The bridging is still taking place, right? So where intents operate a little bit differently is, say, for example, yourself, Austin, you want to execute a trade. What will then happen is we have a solver network within the near network that will actively look for the best route, the fastest speed, the lowest cost. They will compete with each other. And then that intent will be essentially transferred back, and the winning solver will execute that transaction. So from the user or the developer's perspective, the entire process feels like a single transaction. But in reality, the routing and the complexities and the bridging is just happening behind the scenes. So yeah, I would say Aurora and Near Intents are the orchestration platform, right? And then Near Intents protocol itself is more like the decentralized execution engine.
Right. And so when you kind of look at this, like, walk us through sort of all the components that go into actually, like, as you said, from a user perspective, it's like, oh, I have Sol, I'd like Zcash, or I have Zcash, I'd like Sol. I click a button, some magic happens, I get it where I want it. What's actually going on behind the hood, and what are all the sort of different parties involved in that process?
Yeah, so from a user's perspective, it's actually pretty simple, right? So they'll express what intent it is. So let's say, for example, it's depositing USDC into a vault on Morpho. Now, the first step is for the solvers to kind of answer that incoming request. And this is where our decentralized solver network comes into play. So instead of just following a predefined route, multiple solvers will evaluate how they can fulfill that intent. And they'll consider factors like available liquidity, execution costs, or the potential speed of being able to kind of fulfill that intent. Once that's been done, they'll coordinate with whatever infrastructure they need to, so they can tap into bridges, DEXs, or other products that they've got. And then once that's done, the Near Intents protocol itself will verify and settle that. And Aurora will then surface the final result back to the application that's using the product.
So if we kind of walk through like a history of different methods of swapping, we start out with the original Bitcoin Craigslist, meet a guy in a parking lot, hand him some cash, he sends you some Bitcoin. Like, that is like DeFi version 0, right? Mm-hmm. And then we move into these very simple, AMM formulas, which are like a fairly passive activity where like you see pricing responds to the various balancing in a liquidity pool. And then we sort of moved into different systems that now use order book sometimes. There's also prop AMMs, which are a different type of system, but is effectively an on-chain quant trading and market making strategy. Like, under the hood, where does the liquidity provisioning come from? Because Intents it's not a direct peer-to-peer swap in the typical way. There is still some type of market making, either automated or manual system involved, correct?
Yeah, so a lot of that is done at a protocol level, right? So for example, with Aurora Intents, we're not providing direct liquidity ourselves. So of course, Near, is involved in that process. And the solver networks themselves, also from some of that liquidity.
And so when you guys are kind of like thinking about building on top of like one of these primitives that like Near has developed, like, what do you sort of see as the opportunity, and how is this, like, what made you guys decide like, hey, this is a market that there needs to be folks making more accessible and serving data in?
Yeah, no, it's a great question. So I guess there's a number of factors, right, that are at play here. So there's quite a lot of partners that are actively using both, Aurora Intents and Near Intents already, right? I think the lifetime volume's like 21 plus billion.
Yeah, it's crazy.
So we get, considering it's been a year, I think Near Intents is averaging around $1 billion a month now, which is a testament, right, to the problems that it solves. But yeah, so a lot of our partners actually come to us, and say, hey, look, we've got these requirements that we need to do. But additionally as well, from Aurora's point of view, what we've really focused on is providing the kind of base infrastructure that can cover as wider use cases as possible, rather than honing in very specifically. So for example, if we take Intents Connect, Intents Connect, is being leveraged by vault providers. It's being leveraged by payment companies, neobanks. So I think Coca is a great example of this. They're leveraging it for kind of cross-chain deposits directly into the banking app, so users can spend on groceries, so they can fill up their car. Right on the transversely, you've got Declan, which is a wallet that is using the deposits to bring cross-chain assets in, to Solflare from outside of the Solana ecosystem. So again, it's allowing that liquidity to transfer across. So yeah, I mean, the use cases vary quite a bit. We've got RWAs, we've actually got carbon emissions management. So one of our partners is actually managing the offset of carbon emissions with Tesla and Lufthansa Airlines using Aurora Intents, right? So I would say a lot of it is driven by what our partners are requesting. But additionally, what we're also doing is looking at where traction is starting to kind of gather within the crypto market as a whole. So, for example, we're seeing a lot on perps. We're seeing a lot, we're seeing a lot actually in the general kind of spending and finance side. So we've definitely doubled down there, both in Aurora and, of course, we've seen it with Near.com and a lot of the functionality that they've introduced.
Yeah. So, how do you think this fits into the wider, DeFi landscape today? Where do you sort of, because we obviously have, you guys do some bunch of work with Solflare and work on Solana. And so assets come to Solana sort of in many different forms, right? Whether it's the Sunrise guys, which are doing a bunch of tokenized stock systems. There's proper bridging, as you were talking about too. Where do intents sort of fit into that larger ecosystem of how people interact with digital assets? What do you think they're particularly good at?
Yeah. The interesting thing here is Intents by design isn't moving or replacing any current themes that the users are doing, right? All we're doing is removing the barriers and complexity to that adoption. So in terms of where it's going with DeFi, I was on a talk yesterday and Alex, who heads up Diffuse, actually talked about this, right? So this concept of having kind of singular accounts that sit across all of the different networks. I think we're going to see that kind of evolution. And to answer your question specifically in relation to intents, I actually think the biggest movement is going to be around what users expect when they're swapping, right? The concept of confidential intents. So this is something that was released only very recently, where users are now able to kind of swap tokens and move assets confidentially without sharing it with the world. And I think the result that we're seeing from this already, is that institutions are starting to pay more attention. Institutions that previously could not have used crypto rails because they wouldn't want their strategies, for example, to be exposed to competitors, now have that facility by being able to operate cross-chain and being able to operate confidentially.
And so what is where does the confidentiality come in? Because confidentiality is, of course, famously very hard to do in crypto, where everything needs to be publicly verifiable. So walk me through a little bit of how that works in practice.
Yeah. Okay. So in terms of how confidential intents works, what it basically does is it adds the kind of private execution on top of the Near Intents architecture itself, right? So Near has a dedicated private shard in which confidential transactions execute in that separated Near environment. And that's run by a permission set of validators instead of using one public mainnet. And you might have seen this from some of Ilya's talks, right? But Near is basically using a TEE-based bridge to mainnet, right? So the private shard connects directly to Near mainnet through a bridge that runs inside that TEE. And what that basically means is that you've got local encryption taking place instead of relying on kind of client-side proofs, right? And the result of that is users, as you can see with Near.com, have a main account and a confidential account, and you can toggle between them. So some transactions you might care are confidential and other transactions you won't. In the case of developers, essentially they can leverage one-click swap API or Aurora's API, and you'll actually see during that journey for users that they can choose whether it's a normal transaction or a confidential transaction. If it's confidential, it runs through that separate TE.
I'm sure you've talked to a lot of institutions, as you mentioned, sort of maybe have some problems with public blockchains. How do they deal with potential compliance issues? One of the things you hear from institutions all the time is look, one of the things that's hard about DeFi in general is we don't know if we're counter trading with North Korea. And like, obviously they're pretty sure they're not, but like for a large financial institution, pretty sure usually won't cut it with the lawyers. So like in the folks you've talked to about Intents, how are they balancing that desire for confidentiality with some of the compliance needs that are sort of imposed upon their teams?
I think the key kind of component here is that the design for confidential intents deliberately avoids being this kind of black box privacy chain, right? It does support kind of selective disclosure and auditable execution, right? So there's a big difference between confidential and secret.
Yes.
And that's both, from a moral level and then more importantly, a regulatory level, right? So a company or an institution, for example, is still able to reveal their transaction history to regulators or auditors, without that data having to be public to the rest of the world. And that's really kind of the big difference, right? It's ensuring that it's private from competition,
Yes.
but still conforming to regulatory requirements.
Yep. And so when you sort of look at like where this technology is going, do you see like Intents right now, they're not the fastest way to swap an asset, right? Like they're not slow, but like you have consensus on both sides of the systems. And so if what you're doing is like market making or high frequency trading, Intents today are probably not suitable for you. If you're a user who's doing mid frequency or long-term trading or something like that, like they can be a great solution. How do you sort of see the technology evolving? Are there sort of the same way zero knowledge was like, well, like we can see where this tech is going. It just has to get a lot faster before it's useful in the ways that we want it to be. Are Intents sort of in that same space now, or do we run into sort of some different problems when we try and speed them up?
No, so I mean, there's a constant kind of battle, right, in terms of kind of making things faster, and we've already seen pretty good improvements there. However, of course, if you're operating cross-chain, whilst obviously a lot of it's abstracted away, and the use of chain signatures means that you're not having to wait 30 minutes, right, for a particular network to settle. That does in itself carry its own risks, right? And
Yes.
we saw this with the issue with Litecoin that took place a few months ago.
Walk us through kind of what happened there. I think this is something that like I genuinely don't know what happened, but I've been meaning to like get up to speed. So
Okay, yeah. So what we saw, in the Litecoin incident was a coordinated attack that took place on Litecoin, and that resulted in a 13-block reorg. And as a result, it took more than 3 hours to actually generate, right? So during this time, attackers were then performing double spend attacks across multiple cross-chain swapping protocols, and Near Intents was actually exposed to that. Now, in terms of the consequence of an attack like this, what it resulted in, I think it was about 11,000 Litecoins that were swapped out of Litecoin, but then obviously the protocol rolled back the deposit transactions on both Thorchain and Near Intents. So as a result, Near Intents and Thorchain, for that matter, ended up being under-collateralized. So real users lost money as a consequence of this. And again, this is one of the challenges that you have when you're operating cross-chain and you've got networks that are being managed by independent parties. Now, obviously, in this case, Near Intents actually made all of the users whole as well. But to your earlier point, it does kind of expose some of the challenges that you face. When you're trying to move as fast as possible, it means you have to move faster than a lot of these networks can physically settle. So when an incident like this occurs, which, Alex at the time, I think, referenced as being a 17 Sigma event, that's kind of the risk that takes place. But as we move forwards and as the use cases continue to expand, we will see speed increase. What I suspect you might also see is trading, for example, with the example you gave. What I think you'll find is there's going to be very specific liquidity sets for very specific pairs to support those kind of activities. That way you can ensure faster routing. I think it's going to be extremely challenging to try and have parity across, 186 tokens on 27 networks all at the same time, right? We
Yes.
can really concentrate those efforts. And it's not just speed either, it's size. So that's the other challenge which all cross-chain providers face today. And one of the ways that will be tackled is, through partial fulfillment, and of course continuing to grow the liquidity pools as well.
Yeah. And so like in a moment like that, I mean, Near obviously they made a decision to fund this out. What like technically happens once did one side of the bridge system basically fall out of balance? And that's like, because this is sort of like the persistent problem, or at least risk with bridges, is that the assets can become uncollateralized, for lack of a better term, at no fault of the user. And so when you look at like, intents, they're obviously like a much better way to swap, but in some way you don't necessarily lose that kind of black swan risk of like, in this way, there's something wrong with one of the core underlying protocol assets, right?
Yeah. So the challenge that you've got is, if you're moving assets rapidly from one network to another, Near is using its chain signature technology to achieve that, right? So if all of a sudden one of the networks in which you're transferring assets from does a rollback, but you've already basically settled on the destination chain, you then get that imbalance. And that's just kind of one of the risks that you're exposed with when you're not waiting for those networks to settle themselves, but instead you're essentially having accounts sat on both sides or both networks, as it were, and then you're doing that rebalancing. If there is a rollback or an incident like the one I just explained, you are going to end up with a deficit, which is exactly what happened, in the case of the Litecoin attack.
Right. And so how do you guys think about like liability or responsibility there? Like in this case, obviously Near stepped in, but they stepped in and basically used their own balance sheet to make users whole. It wasn't sort of like there's some protocol level dispute resolution there, correct?
Yeah. So Near Intent, it wasn't the Near Foundation. It was actually, the Near Intents team themselves, the Diffuse team that did that. And I think, Alex made that decision along with the team there because it was the right thing to do. In reality, it should have been the affected network that did that.
Yes.
But, when you're operating in a decentralized industry, there is no mechanism to force that kind of behavior, right?
Right.
So again, it's a trade-off. You want users to be confident and to trust both the speed and the security. And in this case, the vulnerability was nothing to do with the Near Intents network whatsoever, right? It was an attack directly on another network. But it doesn't change the fact that users lost out, and I think it's a business decision that has to be made, and it was absolutely the right one, because it's also not the user's fault. They had no way, of knowing what was going to happen. And yeah, I think you have to have those safeguards in place.
Do you think we ever move to a place where we can abstract away some of that risk for users? Like, it's great that Near picked this up, but obviously, they had no legal obligation to do something like that. Do you think there's a world where intents offer some type of better like insurance ability than a typical bridge would? Like I keep thinking about how like custodians charge a certain AUM fee, but they don't actually provide you any insurance. But like, Coinbase One now offers some amount of minor insurance if you pay them monthly. Like, I guess like, is it really just having a better sense of like, well, the Litecoin network maybe wasn't that great and technically to begin with, so like people should hedge their risk accordingly, or like how do you think about user safety in this world?
Yeah, I think that's a really good question. And I often talk about this idea of parity, right? We want Web3 to be widely adopted. Well, imagine if your bank turned around and said, sorry, your money's gone, because someone came and hacked it, or we accidentally, left the back door open and your funds were stolen. It sucks to be you, right? There would be anarchy. And that's why pretty much every major government in the world has an insurance or type of protection in place. In the UK, it's FSDS. I believe the US has a separate one, right? So in the UK, I think it's about 100 grand that is covered if anything happens to the bank, whether it collapses, whether it's hacked, whether it's breached. And I think if we want the world to treat Web3 seriously, when it comes to storing assets, moving assets, and transacting on platforms like Intents, well, then you need to be able to provide that kind of level protection. And I remember when I first entered this space, right, the slogan that I used to hear constantly is "Be your own bank," right? Now, I came from Revolut, by the way. That's where I was before I joined Aurora, and I can tell you, being your own bank is not fun. In practice, in theory, it's amazing, but in practice, not a chance, right? And what's been interesting over the last few years is as more and more people get involved, and certainly institutions and serious companies, we've got the likes of BlackRock, we've got ETFs. Actually, what you're seeing now is that they want stability, they want security, but they still want speed. So to answer your question directly, I think we are going to find ourselves in a situation where, insurance is going to be required. I worked with a project a few years ago called CoinCover that did this, right? They offer insurance within the market, and that's underwritten by Web2 insurers. And I think you are going to see that wider level of adoption. Now, I can't tell you exactly when or if, Near Intents or Aurora is going to be launching that, because I'm pretty sure I'll be murdered. But all I'd say is it's a very interesting and good idea.
Yeah. Yeah, it seems like it's one of those perennial problems where like FDIC is an incredible product because it just gives higher confidence in the entire financial industry.
100%.
Yeah. When you sort of look at like the market today, like where do you think intents are useful for that they're not yet currently being used?
I was actually having this exact conversation this morning with my team, about what verticals can we look at. I'd say Intents is already covering a pretty large percentage of the cross-chain market. I think it's actually over 50% now. Don't hold me to that. But what isn't being particularly capitalized at the moment is, kind of Web2 companies and institutions, right? So lending, settlement, those kind of areas, trading certainly. And I think with the advent of confidential intents again, we're going to see a lot more of that. Outside of that as well, I think there's a lot more that can be done with perps, and some of the gambling spaces as well, I think is going to be a natural evolution, right? From a technical standpoint, not a problem at all. Obviously, everybody has their own views on gambling in general, but we've seen a huge explosion in perps, right? Robinhood, perfect example, right? They're making more revenue now from their Web3 perps and gambling than every other part of their business combined.
Yeah.
Now whether that's good for users is an entirely different story, but what it shows is there's real demand. And I think projects and companies are going to be looking at things like intents to really make that simple and easy, especially given the really tight regulation that exists, within that space.
Yeah, that actually is kind of a good point. Like, are you aware of any intent systems for perps or sort of non-spot use cases today?
I would have to. I'm not off the top of my head. Near.com is obviously a great example. You can trade perps right now within Near.com. But outside of the core Near products, off the top of my head, we have a partner actually called WowMax. They're a Korean, they're a Korean project that actively support both perps and copy trading. And also don't forget that we don't actually communicate and talk to every user of Intents. People can generate their own keys and they can use one click swap,
right,
and they can dive into that straight away. So, there could be more going on there.
Yeah, very interesting. So if folks are interested in learning more about what you guys do, digging in deeper, where can they find more about what you do?
Yeah, so we've got our website, intents.aurora.dev. You can also follow us on Twitter. We also have fortnightly Alpha Leaks call, where we discuss all of the latest features that we're developing, what's coming next on the roadmap. And we've also hosting kind of sporadic, it's actually a brand new series that launched yesterday called Connected, where we're really kind of celebrating new partnerships. So yesterday, for example, we were talking about Solflat, and their introduction of persistent deposit addresses through Aurora Intents.
Yes.
So yeah, you've got quite a few entry points.
Awesome. Well, appreciate your time today, and thank you for joining us on Validated.
Pleasure to be here. Thank you, Austin.
Thanks again.